Good morning, venture capital. This is Metagame, and today we're making the case that Texas already won. It just doesn't need your permission. Here's the thing nobody's talking about in a quarter where 4 companies swallowed 65% of all global venture capital. While everyone was doing the math on $112 billion OpenAI rounds and debating whether Anthropic at $30 billion is cheap or insane, a state in the South put up 106 deals and $6.24 billion, third in the nation, without a single mega round carrying the number. Not one. And the question that should be keeping every mid-market allocator up at night is this. In a market where concentration has become the dominant narrative, what exactly happens to the 24% that's left? Texas just answered that question, and the answer is more interesting than the question. Let's set the stage. Nationally, Q1 looked like this. 1,003 deals tracked by the SEC, $256 billion in capital. Sounds like a healthy market. Then you pull the thread. 41 deals absorbed $193 billion of that. 76% of all capital locked inside 4% of all deals. The national average deal size hit $255.4 million. A number so distorted by the mega-round economy that it's practically useless for anyone not writing checks into frontier model labs. Strip those 41 deals out, and the market you're left with looks completely different. The median deal was $27.6 million. That's the real market. That's where 95% of the actual transactions happened. Texas is playing the median, and it's winning. 106 Form D filings, $6.24 billion. Third nationally behind California and New York. Here's the tell. Texas captured roughly 10.6% of all tracked deals, while its total capital represents about 2.4% of national SEC capital. Deal share running ahead of capital share. That's the signature of a volume market operating at disciplined valuations, not a market waiting for one blowout round to inflate the aggregate. This isn't a lottery ticket state, it's a portfolio state, and there's a meaningful difference. Now let's talk geography, because this is where Texas separates itself from markets that are effectively single-node ecosystems. Dallas led with 36 deals. Austin contributed 26, Houston added 16. Fort Worth and Stafford show up on the board. 4 cities generating Form D filings in a single quarter. That's not cosmetic diversification. That's structural. Dallas, at 36 deals, is the volume leader, consistent with its financial services depth, logistics infrastructure, and enterprise software density. If you're a mid-market fund writing $10 to $50 million checks into B2B software or fintech infrastructure, Dallas is not a discovery. It's confirmation that the deal flow you need is functioning. Austin's 26 deals track its established startup density and the ongoing migration of technology-forward companies that's been running for years. Neither of those surprises you. Houston is the one that should get your attention. 16 deals in Q1 from a city that isn't playing the frontier AI narrative at all. Houston's thesis is different, and it's playing out in real time. VoltaGrid just closed a $1 billion strategic investment from Halliburton and Blackstone. That's a Houston-adjacent energy tech deal that is large, sector-specific, and structurally aligned with industrial capital formation. Not a software venture narrative, not a frontier model bet. Energy infrastructure meeting the power demands that AI deployment actually creates. That's a coherent thesis with direct AI tailwinds, and it doesn't require you to believe in any particular model architecture to underwrite it. And then there's the infrastructure layer sitting underneath all of this. Hut 8 locked a data center lease in Nueces County worth north of $9.8 billion in committed value. Google and Blackstone are moving on an AI cloud venture at potential $25 billion scale. These are not venture events. I want to be precise about that, but they are market structure signals that matter enormously for how you read Texas venture formation. Here's why. Let me break this down. When you see infrastructure capital at that scale landing in a state, it's not just a real estate story. It's a demand signal. Data centers need software. They need integration services. They need vertical tooling for the specific industries they serve. They need hardware optimization layers. Every $1 billion of infrastructure build-out creates a downstream market for the startup layer that services it. The 106 Form D filings in Texas Q1 aren't random. They're partially reflecting the startup ecosystem that's positioning to sell into exactly that infrastructure. That's a coherent AI story. It's just not a frontier model story. Different game, same size outcomes, back to the data. Now the national comparison that really matters. Deal count across SEC filings fell 11.7% from Q4 to Q1. That's a meaningful contraction in the non-mega round market. While the headlines were dominated by nine-figure rounds, the actual deal volume underneath was shrinking. Texas held flat, roughly flat, quarter over quarter, while the national baseline contracted. In a concentration market, flat is the new momentum. The state didn't just hold its position, it outperformed a declining national baseline without anyone noticing because everyone was watching the 41 megarounds. This is the competitive implication that should reframe how you're thinking about portfolio construction right now. When 76% of Q1 capital concentrates inside 41 deals, fund managers outside that mega round tier face a structural choice. You can compete for allocation in the remaining 24%, or you can accept that the market has permanently bifurcated and figure out which side of that bifurcation your fund actually lives on. Texas, with 106 deals at $6.24 billion, represents approximately 10% of the non-mega round deal universe operating at scale. For mid-market and growth stage funds, that's not a small opportunity. That's an anchor market. The risk, and this is the one I want to name directly, is that VCs extrapolate the concentration narrative too aggressively. The top of the market is real. OpenAI at $122 billion is real. Anthropic at $30 billion is real. XAI at $20 billion is real. Waymo at $16 billion is real. None of that is fiction. But the mistake is assuming that because the top of the market is locked by 4 companies, everything below is undifferentiated or contracting. Texas disproves that. The state held deal count flat while national volume fell. Ignoring durable distributed markets while chasing concentration exposure creates a specific kind of portfolio construction asymmetry: high concentration at the top, thin coverage in the middle where the median deal at $27.6 million is getting done every single day. 3 vectors deserve underwriting attention right now. Houston Energy Tech, Voltagrid scale outcomes are available without frontier model exposure, and the energy AI convergence thesis is early enough that sourcing is still local and pricing is still rational. Dallas Enterprise and Financial Services Infrastructure, 36 deals in a single quarter, suggests deal flow that rewards having someone in the room, not flying in for pitch day. And Texas AI infrastructure adjacency, the physical build-out, documented this quarter, creates demand for vertical software, integration services, and hardware optimization that fits exactly in the $20 to $50 million check range, where most of your competitors aren't looking because they're too busy refreshing their OpenAI cap table models. Here's where we close the loop. I opened with a question. In a market where 4 companies took 65% of all global venture capital, what happens to the 24% that's left? Texas is 10% of that answer. 106 deals, $6.24 billion, third in the nation, 3 cities generating distributed formation at disciplined valuations while national deal volume contracted. No single event defines the quarter. No single city carries the number. No mega round inflates the aggregate. That's not luck. That's structure. The portfolio state held its position in a quarter when concentration ate everything above it. And the positioning question, the one that practically answers itself, is whether your portfolio did too. In a market dominated by 4 companies and $122 billion rounds, dependable is the most underpriced word in venture capital. Texas just posted the proof of concept. The only question left is whether you were paying attention. That's our venture capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grab news. Thomas.